Hello friends, welcome to the world of prosperity. Today's video will be talking about what is reasonable rate of return. In fact, many people they ask, how should we decide what is reasonable rate of return or what is the return we should expect on various investments. So today's video will give you some insights on what is reasonable rate of return and how you should consider the rate of return. So let's deep dive into it and let me share my mind map. So when we talk about reasonable rate of return, so first thing you need to understand what is rate of return. So rate of return is something when you invest your money, that's the kind of income profit out of that investment. And how do you measure it? You measure it in terms of rate of return. For example, you make an investment of say 10,000 rupees at a rate of say 7%. So end of the year you will get 700 rupees out of it. So that means the rate of return is 7%, and end of the year you're getting 10,000, which is the original principal money, plus 700, which is the interest, and which makes your total balance as 10,700, just to give you a basic understanding. So this is how rate of return works. Now the question comes, how to decide, what is reasonable, right? So though there is no hard and fast rule, but there has to be some baseline to understand what rate is reasonable, because there's a correlation between risk and return, right? So there has to be some base return which you can refer, right? So one of the base which you need to consider is inflation. So when we talk about inflation, that is one reference. So whatever is the rate of inflation, that becomes your target, minimum target rate of return. So suppose if the inflation is hovering around say 6%, so to ensure that you are getting rate of return more than the inflation, so that your real value of capital stays intact. So it is very, very important to consider the inflation rate. So suppose the inflation rate is hovering around say at 6%, and you are investing your money at say 3%. So in real value, actually your money, the real value of your money is going down or decreasing year by year, right? So that becomes your first reference rate, which you should consider, that this is the rate you must look out for, right? Second interest rate which you should consider is the government long-term bond rate. So if you open the RBI website and you check what is the long-term bond rate, so that becomes your safest rate of return which the government of India is offering on a long-term basis. So that becomes your reference rate as the safest investment option. And if there is any other rate which is over, either over this rate or below this rate, so this becomes your demarcation rate, that this is the safest rate of interest which is being offered. Any other rate, suppose any rate somebody offers you very odd rate, then you can actually refer back what is the baseline, how far it is from the baseline, and accordingly you can decide the level of risk which you may assume if you opt for say higher rate of return, right? So this is about the basic understanding, what is reasonable and what rate you should refer to. So now let's deep dive into it, like different rates by different investment options. And all these rates which I'm telling, these are just approximate for reference and understanding. Maybe you need to check the actual investment and the past performance for the actual rates which is coming. So these are just for reference purpose. So when we talk about different investment, the base investment is your cash, right? So if you keep your money in cash with you, there is no interest, right? There is no interest being offered. It will, you can say, is a zero rate of interest, right? Because if you keep money in your pocket, there is no interest, right? It will remain a cash because this is the original currency. Next comes the saving account. If your money is lying in the saving account, the banks are hovering around say 2-3% annual rate of return, which is they are giving by way of interest on the saving bank, and that is how the banks make money. From this money, they actually lend it outside at a much higher rate, and the difference is their income, right? So saving bank actually offers around 2-3%. Some banks, they did offer, as a special case, slightly higher or maybe equivalent to deposit rate, but that is, can be decided by each individual bank. But this is the basic, rate which is being offered to a saving bank account. The third comes the fixed deposits and bonds. So currently, fixed deposits and bonds, the rate is hovering around say 5 to 7%, and maybe in some case slightly higher than that. But that is how it works. And the government long-term bonds also, they are around this rate, and maybe you can check the actual situation, with the latest offerings. But this is the long-term, you can say, the secured rate of return that becomes your baseline. Then comes some fluctuating investment like mutual funds. The mutual fund, you can get a rate of return or of around say 8 to 12%, depending on what mutual fund and how is their performance over the period. Similarly, if you invest into direct equity shares, so here also there is no fixed rate of return, but approximately, you may earn maybe anywhere between to 12 to 15%, depending on the performance of individual shares. And believe me, these are not fixed rate of return; these are fluctuating, and depending on the performance of the market and shares, you will get this kind of return, right? So now the thing is, why these, why the understanding of these basic rates is important is because if you know the baseline, then for you it is very easy to raise the red flag if you get any extraordinary rate of return, or if somebody offers, some extraordinary rates, then you can easily decide, whether those rates are acceptable, not acceptable, or what is the level of risk, being assumed in those investments. For example, if I offer you say 20% per annum, then you can easily decide that the government of India is offering say 7%. How come this person is offering 20%? So what is the kind of risk which is being involved in this? So that is why knowing these rates are very, very important. Of course, you may have heard about multi-bagger, rate of return in some investment options. But again, as I mentioned, the government of India baseline, rate of return, and whatever extraordinary return you're getting, you must understand the level of risk which is involved into that, right? Don't just go by the, those extraordinary rate of return or multi-bagger returns which are going. Those may be reality, but you need to assume, you need to understand what kind of risk being involved in that, or what is the, technical skills you need to acquire to, achieve those kind of results. So that is about, how, other investments are behaving. Now the question comes, what is your target and action? As I mentioned, the purpose of this, video is uh, to have a basic understanding of what is reasonable rate of return. So what you need to do is you need to, uh, list out all your investment and see what is the average return you are getting in that, and see what is the level of risk in each individual investment. And the target is you should always try to beat the inflation to protect your real value of money. That is one target which you must have. For example, suppose the inflation is at say 6% and you are getting around say 2-3%, it means the real value of your money is going down. So you must, come out of those investments and at least try to beat the inflation in your investments. Second important thing is, there is something called compounding. So you should compound at the best possible rate according to your risk profile and plan accordingly, right? So first you need to decide what is your risk profile, and accordingly you should select the investment and then compound your money with that rate, right? So that you are very, very clear about your plan, that how your money will grow over the period of time, right? So don't just do random investment. Be very clear on, where you're heading to in this investment journey. So that's all for this video. I am sure this video would have brought some clarity about what is a reasonable rate of return. If you like the video, please do share it with your near and dear so that they can gain clarity, about the reasonable rate of return. And if you have not yet subscribed to my video channel, please do subscribe and press the bell icon, which is the usual statement, right? And you can always follow me on hashtag CSunilGupta95 for my other social media handles. And that's all, and I'll be happy to hear your comments. If you have any other outlook on this, please do share in the comment box. Thank you very much, and I am sure this video was valuable and informative. We'll look forward for your comments. So thank you. Goodbye.